Chris Price, one of our certified financial planners and retirement income specialists. And today we're going to talk about something that every investor needs to understand. So I don't care if you're just starting out or maybe you manage a significant amount of wealth. What I'm talking about today is asset allocation. So in simple terms, this is how you divide your money between different investments like stocks, bonds, cash, alternatives. And let me tell you right up front, this is not a technical detail. This is not something that's only for the professionals. This is probably the single most important decision you're going to make as an investor. So those of you who don't know, what is asset allocation? Asset allocation is really your game plan. It's how you manage risk, how you build wealth, how you stay invested throughout every type of market. So instead of focusing on what the next hot stock is, we want to focus on the percentage of our money which should be in growth investments, how much should be stable, how much should be liquid. And there's a lot of research behind this. So research has been shown that 90% of our long-term investment performance comes to how our portfolio is allocated, not about individual stocks and not about market timing. We're going to talk about really like the 4 different ways that we use asset allocation. Let's break those down. So the most common strategies we use for our clients are here. First one, strategic asset allocation. This is your long-term roadmap. You pick a mix of stocks and bonds, let's say 70 or 30, and you rebalance it once or twice a year. This is great for people when there's a clear goal and a long time horizon, especially if you want a simple and disciplined approach. The next one is called tactical asset allocation. This is more of an active strategy. This is where we're going to make short-term shifts based on market conditions. So let's say there might be signs of a recession. We may reduce stock, increase bonds or cash to prepare for that. Right? This strategy requires a lot more attention, and it's best for people who want to play offense, let's just say, when conditions change. The third one is called dynamic allocation. This strategy adjusts as your life changes, right? You're not just reacting to what the markets do, you're also reacting to what your own needs might be. So let's use an example. Let's say you're a business owner and you're approaching retirement. You might want to reduce your equity exposure and increase income generating investments. So this strategy is more flexible, it's more of a personal approach, and it's common with our clients who want to evolve over time. And finally, let's talk about the core satellite strategy. This one blends stability and opportunity together. So what you first do is you build a low-cost, diverse core. Use like index funds, things of that nature. And then you add satellite positions around it. These are things for growth or special situations that are unique to that time period. So this will both give you some consistency and will give you upside potential, but it does come with a little bit more risk. So how does this apply to you? Well, your allocation should depend on your goals, your time horizon, and your stages you have in life. Right? If you're just starting out, hypothetically, your focus should be on growth. You should be heavier in equities. Right? If you're in your 40s or 50s, you may want to blend. You still want to grow, but you may want to start beginning to talk about reducing risk. And if you're in or near retirement, your allocation should start generating income and protect the principal that you've built. One of the strategies people use to kind of combine some of these is what we call a 3-bucket strategy. Now the model of this 3-bucket strategy is to basically allocate your money with different goals and then allocate within them. So bucket 1 is all about safety. It's your cash or near cash reserves. This is what you're going to use in the next couple of years in retirement. Bucket 2 is your income. This is your next 5 to 7 years. Things of bonds, dividend stocks, things of that nature. And bucket 3 is for growth. This is for your long-term money. And trust me, your future self will thank you for this one. So this approach gives you permission to invest long-term because you know your short-term needs are already covered. So now, over time, your allocations will shift. Stocks may rally and push your equity exposure too high. So even though you're doing all this, make sure you rebalance. This is why rebalancing systematically brings your portfolio back to the intended mix. It is super important. This will protect you from taking on more risks than you plan to take, and will enforce the discipline of buying low and selling high. Now, I know I talked about all those asset allocations. Asset allocation isn't just about the investments, but also the taxes you have. So for like business owners or high income earners, you want to focus on tax allocation. Right? We would hold tax inefficient investments in retirement accounts, and maybe our biggest growth assets in our Roth IRAs when possible. So your allocation isn't just smart, but it's also tax efficient. Now, here's the bottom line, let's just say. Asset allocation is the blueprint for your financial independence. Again, it represents 90% of your investment return in a portfolio. If you build the right allocation aligned to your goals, your time horizon, and your risk tolerance, you'll be able to weather the storm, weather market volatility. You'll be able to stay focused, and that's what matters. So if you're unsure whether your current portfolio is allocated correctly, or if you've never really had a formal investment plan, call us, schedule a time with my team. There will be a link below, like there usually is. And I want to say thank you for watching. Be sure to subscribe for more real-world financial strategies designed for your life. Have a great day.